This is the conversation of the day. Fred Lane has spent an apparent generation helping people stay in the market. He's at Raymond James, but nominally is with Lane Generational. And I love, Fred, this statement from your bio. Streamlined solutions for the lifetime of needs. The major need right now is courage to be in the markets. Where do you find the courage?
Perspective, history.
History, thank you.
History. I mean, Bayesian thinking helps. You have to look at the past and you have to look at current inputs. And if you look at the past and you look at current inputs, this is a very good time to be in the market. The doomsdayers notwithstanding.
You've got a comfortable clientele. They like to be in comfortable stocks. Do you want to be comfortable now, and what does comfortable mean?
Well, I think when you're in the equity markets, you should never be comfortable. You should never be basically too relaxed about the whole situation.
Is Amazon comfortable right now? Everybody's on board. It's the story of the moment.
Those are generally stocks that people should be cautious about. But I mean, obviously it's got a great runway. So I'd rather not comment about Amazon specifically, but there are stocks. Look, I mean, Amazon pervades our life. Technology pervades our life. I like to play in places, I like to invest in sectors where there's secular growth. Healthcare is one, technology is another, communication services. These are all important themes that are going to be going on for 5, 10, 15, 20 years, and nothing's going to derail them. Amazon is such a theme as well in terms of the shopping patterns, the characterize how we live.
Fred, let me push back a little bit, because look, whether you're doomsday or not, at some point the market has to correct. We had 10 years of bull run, right?
Absolutely
so when does it correct?
I don't care. I really don't care. I mean, the fact of the matter, that sounds like a very cavalier comment on my part, but yes, you're right. We are going to correct it. It corrected in 15.
But how can you not
It corrected in 16.
Right.
Okay. We haven't had a correction recently. I've told clients, expect one. Okay, and in many cases, we're keeping some money on the sidelines, so when there is a correction of 10 or 15%, it won't be fun. Oh, by the way.
You go back in or you get out?
Oh, no, we'll be going back in, for sure. Right. What I'm concerned about is if GDP starts to really lag and corporate earnings start to decrease or growth really slows down, then we have a recession, perhaps, that we have to confront. We're not there.
Okay. George, do you agree with that? We're going to have a correction?
Yeah, look, I think we're due to have a correction at some point, but anyone that's trying to really time that as a fool's errand, and I think Fred's point's really on point, that we'll have these episodes. People are still fearing the financial crisis, and so I think we'll have these episodes of corrections, which will be opportunities to get back into the market.
Mr. Lane, I want to go to the media a moment where Comcast is being absolutely trashed. I mean, there's this, that, and the other thing. I don't want you to be a securities analyst on Mr. Roberts' fiefdom, but the fact is, boy, does it look like a value this morning. How do you discern a value in Comcast from a value trap in Comcast?
That's a very difficult question because the media space is as roiled as I've ever seen it. 20 years ago, if you could own cable stations, it was the greatest thing in the world. Likewise with cellular phones, I might add. This is a very different world we live in. So when we don't understand industry patterns very well, and there's a lot of cross currents, we tend to steer clear of that sector. Specifically because we think it becomes more of a bet, has more betting elements to it than investment elements. I like to know exactly what I'm investing in and why I'm investing in it.
Is there 50% of the future that we don't understand? I don't know. We're always on social media. what impact does that have? The Internet of Things, what does that mean? Am I going to be connected with? So you stay away from all of that?
No, quite the opposite. What I look at is I want the tools. I want to be investing in the tools that allow all that to happen. For example, I like the semiconductor space for that reason.
Right.
Long term. I'm not recommending any semiconductor stocks here. But nonetheless, I like technology for that reason. Likewise, in healthcare, I happen to like the life sciences space because those are the tools whereby research is being done. The individual bets on the biotechnology companies and the pharmaceutical companies, the individual investments, I should say, those are valid. But the tools companies, to me, are even more attractive.
Okay, George, do you agree with that overall assessment? We do have, first of all, the chart, I think, looking at the bull run over the last 10 years. But if you look at the markets overall, is there anything that looks like it's in a bubble, either because the change, the rapid change of technology or anything else?
I mean, the question really, I think, and that's what central bankers are all taking a really big gamble on, or I guess really have confidence, I should say. They're taking away easy money, and now we're going to see if we can stand on our own 2 feet and take off the trading wheels. And can financial asset valuations hang in there? I think that's a real litmus test that's really out there. I mean, I think, once we get rates high enough and spreads start to widen, there could be a repeat of 2015, 2016 in certain sectors, but it won't be cataclysmic in our view.
This is what we love to do on surveillance. We've got an equity guy and a bond guy, and they're sort of crossing here when you look at the short-term rate and the dividend growth as well. George, let me go to you with this chart. Bring this chart up right now. We've shown it a million times. I'll probably show it in the Fed show tomorrow at 2 p.m. With Scarlett. And it's the real Fed funds target rate. And I'm sorry, George, it's not happening. We're not even near a positive real rate. When real rates get real, George, bond guy, what happens to Fred Lane's world?
They're not there yet. I agree with you. I think once we get there by the middle of next year into the end of next year, combined with the fiscal stimulus burn-off, that could become an issue. But we're not there. And to kind of prejudge that now, you have 1 year until that happens. Why prejudge it?
Fred, we've seen this before. I mean, all of a sudden, George's world is going to become competitive with dividend and with dividend growth. What happens? Do you go onto the desk, rather?
I doubt that's going to happen. And let me explain why I doubt it's going to happen. I just think there's such a strong demand demographically for fixed income assets because of retirement plans, 401ks,
price
et cetera.
up, yield down.
Yes, that I don't think we're going to see 5% and 6% interest rates anytime soon. To me, it's rather unimaginable. Unless we have.
Then they're on the same page.
Okay, let me see if I can find disagreement maybe with the recession.
Good luck with that.
Okay. On a recession, you come at the end of it, we're late cycle in the U.S. At some point, the tax cuts are going to run out.
Yes.
Are we going to see a U.S. recession?
We could have a recession. We could have a growth recession. Either way, it's going to be a garden variety recession. We're still spooked by the crisis of 10 years ago that we think we're going to have some sort of big downdraft. It could be 1 or 2 weak quarters, and that's it.
You agree?
I agree
Come on,
with that.
Fred, don't agree.
I agree with that. My bigger concern, okay, first, let me throw out one other little detail here. We have fewer than half the number of publicly traded U.S. stocks than we did 20 years ago. So there's a supply-demand imbalance for U.S. equities in general. I know that sounds like a kind of a strange concept, but supply and demand, it matters, okay? That's the first thing. The second thing is, until interest rates and unless interest rates get to a level that's really competitive with any low-end estimate of earnings growth for the S&P 500, use 4 or 5% even,
right.
Over time, that's a very low interest rate. I think equities remain highly competitive.
We've got to go, but I want to congratulate you on staying in the market from 2009. For the few people like you, it's been extraordinary. I want to congratulate you on driving Fed policy tomorrow. George Goncalves,
keep it going
with us with Nomura
as
well. This
Thank
has
you.
been a spirited conversation. That's what we like here.